Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful. Roll time. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got it spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out, and then you don't think that anything is wrong? Come back tomorrow and I'll lose it all. It should be fun.
Good morning, everybody. It's Friday. Hey, we got some important numbers today, right? We got that U.S. Core PCE price index coming out in a minute and 30 seconds. Oh my gosh, guys, I'm like so behind. Why did I take so long to get ready today? Well, you know what? This is not one that I think I want to trade live. Look at that spread in the micro. Wow. Let's just come through the market here real quick while we're waiting. So Treasury's down just a tad overnight. ES holding its gains from yesterday fairly well. Oil heading higher. Natural gas still down from yesterday. Gold and silver taking a jump. Well, silver getting hammered there, but gold and silver doing okay overnight. Copper coming back. The dollar. Well, Bitcoin coming back down again. And the dollar still pretty strong, but not nearly as strong as it was yesterday. So here we go. We're going to get, again, U.S. PCE price index. This is the Federal Reserve's favored measure of inflation. So that number, the core PCE price index, month over month, we're looking for a reading of spot 3. We also get consumer spending and personal income. Those are going to be key numbers here too. So I cannot trade it. There are absolutely no micro contracts being offered. Okay. So I'm not hearing anything from the squawk yet. We're still waiting, but oh man, it looks bad. It looks bad. That must mean that the PCE was really high. Okay, so quarter PCE was in line, but we got real personal consumption, spot 2 versus a negative spot 1 expected. U.S. personal income, spot 5 versus an expected spot 4. Consumer spending, spot 1 versus spot 6. I can see why that would maybe make them be a little bit hawkish here on the rates, but it is not. Listen, this is not one that we can trade, unfortunately. If we want to trade it with the micros, this is not one that we can trade. But it looks like the degree of the move that we had there, it may be a little overstated there, because I'm not so sure that some of these personal income and consumer spending numbers being a little bit higher than expected, it really necessitates that much hawkishness. And we are likely to see, well, so where were we when we started? 08.5? They are bouncing back real hard. Look at that. Wow. So there was a big old monster iceberg at 30.5, huh? And what's the S&P 500 doing? S&P 500 is moving down. Gold is moving down. Dollar moving up. We might need to. I guess I can't zoom the dollar out more. There was at points higher earlier overnight. Oil not really responding though. Interesting. Very interesting. Oh, Elon Musk is up and tweeting early today. He says the far left hates everyone, themselves included. Oh, that's so funny. I can't believe he tweeted that. You know what this is? This is, oh, now we have free speech. Elon Musk can say what he really thinks. Wow. Okay. Okay. Okay, so it looks like we got a liquidity hole at O2 here a little bit. You got to be careful about the liquidity holes in this really fast action because, you know, you're going to get waves of volume come through here. I'm going to let it settle down. Yep. Those most vocally against Elon's takeover of Twitter are those that have benefited the most from the exclusion of opinions that contradict their own. 100%. Dude, yeah, Cat Turd just retweeted Elon's tweet saying, "This is getting good." Yeah. It really is. Like, oh man. Oh man. They're still there. They're still there. By the way, did we see things spread a little bit? It looks like everything flattened. It looks like everything flattened. Well, I think we might want to dig into some of these while we're waiting, while we're kind of chilling here. That is just the okay. Well, okay. So I'm just realizing now it's like the last day of the month. So we could roll over. Let's roll over and see if there's more liquidity on the other contract. There probably is. This is not tradable. Okay. Come down here 2-year May. Yeah, let's start with the 10-year. Start with the 10-year, and that'll give us a good idea of if what it's going to be. And if it's not, then maybe we just don't take any trades today. Okay, so the spread is really wide here in May, but there is more liquidity. It does look like the major liquidity providers here in this instance are in fact over in May. So we'll stick to May. Consumer spending. Well, it was definitely all that economic news that we just had. I must say, it seems like the markets are reacting a little bit more dramatically to this piece of news than I would have expected based on what the numbers are. But we're in a very illiquid market in general. There was a huge iceberg here at 30.5. Somebody was willing to buy it there at 30.5. I guess that's kind of been support as of late. So that might just be like a technical trade. It has nothing to do with the news. I'm really curious though. Okay, so we're coming in here. Core PCE price index. Let's come in and look at this report, shall we? Full release and tables. So this is one of those ones where it's like it's really good to come in and read it. At least highlights. They've got frequently asked questions. Like there's so much information about this one, right? Full release and tables. Personal income increased 107 $88.2 billion in March, according to estimates released today by the Bureau of Economic Analysis. Disposable personal income increased $89.7 billion, and personal consumption expenditures increased $185 billion. Real DPI increased 0.4% in March, and real PCE increased 0.2%. Goods decreased 0.5% and services increased 0.6%. The PCE price index increased 0.9%, excluding food and energy. The PCE price index increased 0.3%. So you can see here, personal income did increase, but not as much as last month. Disposable income still up, but not as much as last month. Current dollars. So they're actually in this information, there is kind of like a little bit of a sign of like peak inflation here, actually. Like, it seems to me like there's actually some signs of peak inflation, because even though it's still growing, it's not growing as fast. The increase in personal income in March primarily reflected an increase in compensation, proprietors' income, personal income, receipts on assets, and government social benefits. Within the compensation, the increase reflected increases in both private and government wages and salaries. The increase in proprietors' income was in farm income, reflecting increased crop and livestock prices. The increase in personal income receipts on assets was led by personal interest income. The increase in government social benefits was led by Medicare and Medicaid. I see. The increase in current dollar PCE in March reflected an increase of $114 billion in spending for services and an increase of $70 billion in spending for goods. With certain services, increases were widespread across all components and led by other services, which includes international travel, as well as food services and accommodations. Within goods, an increase in non-durable goods, led by gasoline and other energy goods, was partially offset by a decrease in spending on durable goods, led by motor vehicles and parts. Spending on food services, as well as most categories of goods, reflected updated consensus retail sales data that were recently benchmarked to results from the most recent annual survey. Detailed inflation on monthly PCE can be found here. Yeah, okay, so that might be a key point of contention for some of the what do I say, contrarians out there. So personal outlays increased $188.9 billion in March. Personal saving was $1.5 trillion in March, and the personal savings as a percentage of disposable income, was 6.2%. The PCE price index for March increased 6.6% from 1 year ago, reflecting increases in both goods and services. Energy prices increased 33.9%, while food prices increased 9.2%. Oy. Then you get all this stuff. See, this report is really cool. I just like really complicated tables. I look at those and I'm like, oh, let's take that into Excel or maybe even put it into R, make some pretty charts, do some funky analysis on it, see what we can get. I don't have any ideas about what we would do with it, but it just looks like fun data to me, That looks like fun data to me. These are all numbers, so it's kind of hard to see. Okay, here we go. Oh, that's in billions of dollars. Percent change from preceding months. There you go. This is the one that you kind of want to look at, right? So here you can see compensation of employees was 1% last month in February, and it was 0.5% in March. So signs of peak inflation there, right? Signs of right. And then personal consumption. Okay, so personal consumption expenditures increased. Interesting. And that was led by a very large increase in non-durable goods. My food is hitting my stomach, and it's hitting hard. It's probably because I ate a salad last night. Okay, well, they've been chopping around in this O2 area now for a little bit. They may be ready. I mean, this is an area where we could maybe try and do something. Like maybe down in here. We think that it's going to come back. I don't know. Kind of interested. I don't really. Let's see here. News Squawk. Well, today's core PCE confirmed the softening seen in the CPI. The Fed fears of second round effects will not be quelled on the back of the employment class index surging 1.4% in quarter one, well above the expected 1.1. Okay. I see what he's saying. So yes, they're saying yes. Seth is right that there is some signs of peak inflation in here, but there are also some information that shows that the inflation that we did get in the first quarter was actually a little bit more than we expected. Right? My nose itches a ton this morning again. Well, we are seeing, generally speaking, gold falling down. The S&P 500 did move there, but not too dramatically. I think that my chart here is messed up a little bit. I think that we kind of lost data there for a little bit, so but I'm no fan of the far right either. Let's have less hate and more love. Yeah, I watched that. It was cool. I didn't really see a whole lot of like new information in that, but I think that it's really important for these guys that were in the pit to thoroughly document and relate their experiences as much as possible. For two reasons. The first is that I don't think it's ever going to exist again, right? And if bits ever did come back, they're probably going to be different. So, for historical purposes, it's important to keep that because these people experienced an important part of history that nobody else is ever going to be able to experience, and so they got to tell us what it was like because there's a lot that we can learn from that history, right? And then the second thing is that it lets us know about the history, or like it's important to understand the history to understand why the market is the way it is today. Because one of the mistakes that a lot of retail traders make is they're trading off of things like that they heard traders did in the 80s, 90s, and to turn of the millennium. And they don't understand how today's market is different. And so they often will chase after things that don't really. I think probably the best example is pivots. Like a floor pivot is a really great, if you're on the floor, right? And you got to remember a couple of key numbers, and you don't have a chart to look at, so it's kind of hard for you to sort out where you actually are, floor pivots are really, really useful. But from the back testing that I've done on them, they are not very effective when you trade on them in today's market. And so maybe they were like key points just because people were looking at them a lot, but they don't appear to have any edge, So, I don't think that traders, a lot of new traders, they don't think about that sort of thing. They just think, oh, here's something from a pro. I'm just gonna do what they did or whatever the deal is, right? Like the way that I want you guys to approach this sort of thing. Hey, you're my guys, right? Here's my advice. When you watch something like that, here's what you should be thinking. Okay, here's how these guys did it. How am I going to beat them? That's the way you got to think about it, man. If you want to have success in this industry, you're not having success right now. You've got to be thinking, how am I going to evolve? What is the market like right now? What are the things that people are using to dominate in today's market? And what can I do to get an advantage over them? Right? There was a lot of interesting stuff that happened. There's a lot of big advantages, interesting advantages that you had when you were on the floor. You could see who was doing what. You could have relationships. So you could be, you would be the floor local and you would be talking to the big funds that come into the market and you would have a relationship with them. And, they wouldn't like necessarily intentionally screw you over because they knew that if they did that, then they wouldn't have anybody to transact with. It's not the case in this market. In this market, they just roll over you, Not that I'm saying that they were nice necessarily, but I'm just saying, yeah, you knew who you were trading against. That changes things a lot, right? Yeah, I have that in this market. But then something happened. They moved to electronic. The electronic trading was way more efficient, and the guys that were doing the trading on the electronic started to dominate to the point where the guys on the floor basically like all disappeared because all the trading went to electronic, right? So then in the early 2000s, we had all of these people trading electronically and doing market making electronically. And then something happened. Well, it was 9/11. 9/11 happened, but that killed a lot of people. But then after that happened, we started to see the algorithms start to come in, right? And then things changed again. Basically, an army of PhDs came in and completely changed the market. They discovered some things that gave them a huge advantage over everybody else. Now, part of that was just removing the arbitrage opportunity that a lot of people were relying on. So you couldn't really like pure market make anymore, at least not in E-mini futures. But it was more than that. It's more than that. It was also how they executed their large block trades and stuff like that. There was a time when you'd see these block orders, and because they were executing against the VWAP, you could really trade against them and push the market against them and stuff. But then the quants came along and Omgra and Chris came along and that changed, right? It's really odd to me that when this changed, that the retail market didn't keep up with it. That's really what happened. Really what happened was that the new stuff that came in was so sophisticated compared to what people were trading on before. And look, a lot of these guys, they weren't masters, PhDs in math, right? And that's what all of this new stuff is based on. So a lot of it probably went over their head, but probably more so than that, because I think that you guys can totally understand this if you really want to learn, and think that we've done a good job making videos that digest it down for you, right? But they weren't even looking for it because they didn't know necessarily that this is going on. They didn't know that, oh, well, the place for me to go was to go down to the university and start reading the studies that are being released about optimal execution and stuff, right? But now we know. You got somebody here that had enough insight into the industry to know where they were kind of grabbing their edge from, but wasn't involved enough in there that he wouldn't be talking to you, right? To come in and tell you what's where to look. But all that does is get you back to even with knowing what the major players in the market know. And of course, they're going to take that research further, right? So you're going to have to take that research further. You're going to have to learn the things, understand those models and stuff, and start to generate your own models about the markets. Now, there is one place where I think we kind of have an advantage, and that is this whole inelastic market thing, right? Understanding the inelastic market gives you a place to do your own research and gives you a lot of ideas about your own research that hasn't been done yet, and gives you some ideas about where you might be able to find that advantage, right? So that's what I think about those things, right? Think about, how am I going to evolve? You know, I think coming into 2020 was still very unhappy about my trading, and I really wanted to evolve my trading. I didn't know what the next step was. You know, it was like I couldn't find, was digging and digging for something, and I couldn't find it. And we were lucky that we got a few hints, and I had the background to understand it, right? And we evolved. But we got to keep evolving, right? I do think I'm at the point where probably focusing on my psychology is probably going to be a lot more useful, because I can definitely get into these modes where like I literally can't lose. And then like one losing trade will like really screw that up, right? So this time around, I think I realized I was kind of in that spot, didn't do too much damage. Also, kind of realizing that we're in a market that's not too favorable to us at the moment. Man, this spread in the micros is just yuck. And you can see, by the way, like the 5-year still doesn't have anybody market making on it. Still doesn't. Maybe we should come in and figure out what the price is, and try and fix it for them. I can't even see. I don't know if my DOM isn't really set up to be able to do it. If we had it open before and we could see where the last orders had been placed, then maybe we could see it. But so I don't know if that would be a point. But I do have some stuff written that would allow us to calculate what the correct interest rate should be. You want to see? Do you want to see how many people do we got here this morning, by the way? Okay, we're doing okay. Sometimes I'm like, did I not make it public? I've done that a couple of times. No, we're about what we should be. Okay, so let me come in and try and do this. So what we're going to do is we're going to add a ZF 5-year note. One-minute bars, sure. And then I'm going to come back and I'm going to add 5YR. And I'm going to make these ones tick charts. Just one tick chart. Okay. Wow. Has there not been any activity at all? Well, it's going to be somewhere around 2.875. Okay, now we need to come over to the CME and grab some information from the CME. Actually, let me add the indicator first. I think it's this one. Yep, this one. Okay. Okay, it looks like they're pushing new lows. It's getting pretty aggressively short there in the treasury. Glad I didn't try reversing that. I was kind of tempted to. Okay, so here we go. Treasury Analytics, 5-year. Right? Okay, so the anchor price that we get here. Oh, I need to make something to be able to put the anchor price in a little bit more accurately. So what's going to be 112 and 1750. 17. So so it's 35 over 64. 0.5 over 6875. Okay. And The DVL1 is 45.37. I forget if I use the OTR one or the futures one, but I'm going to use the futures one. And the OTR yield is 2.8388. Okay. So they're saying that the yield right now is 2.854. Well, how am I ever? I wish there was a way. Okay, we'll do it this way. Order ticket. $5YR. Let's see if it will reject. I think that it will reject it. So we're going to put it at 2.850. 5-year day buy. I bet you it rejects me. Oh, that didn't. Clicking the button didn't do anything. Did I not? He says that right now it says bid is 2.854, which is correct. Oh wait, it did submit it. It did submit it. So, oh, but I don't see it. I'm not seeing it. So 0522. Maybe if I come over here. I don't know. Well, I'm gonna cancel my order. For some reason, it didn't show that. Like I did it with my live account, but I didn't. My DOM apparently didn't see the update or whatever. Because let's just try reloading things here. If I go 5YR here, okay. No. Hmm. I'm gonna go and complain about it to Jigsaw. What are the constituents of the most sophisticated making algos and features? Oh, well, I don't know. I can tell you a few components of an automated trading system that you could probably incorporate, though. First one is that you're going to want to have some sort of correlation or statistical arbitrage stat that you're using to determine what price to bid and ask on. So in this particular instance, if we were going to do it with the 5-year, we could use this indicator that I have right here, right? Where I am calculating what the 5-year yield should be based on the metrics and the DVO1 and everything else like that, right? There's going to be a little bit of error in it. But roughly speaking, I can tell you what the 5-year yield should be based on what the 5-year futures price is. Okay. So that's going to be our arbitrage thing, right? We're going to market make over here. Okay. Next thing is we're going to want something to deal with adverse excursion. So if we get fills, right, and we're seeing some volume come in against us, we might want to cancel some of our orders on the inside and increase our spread based on that activity to account for that activity. So that's the next really key part. And in addition, like inventory management, so that, you can only take on so many contracts. And if you have too much inventory in a certain way, that it will work harder to try and offload that inventory, right? So those are kind of some really starter things. And then I think some next steps after that would be like, for instance, using, I'm going to close this, making it utilize information that it might know about the seasonality of the instrument and the day of the month that it is and so forth to adjust whether it thinks that we're more likely to be buying and selling and whatnot. So that's maybe a little bit more advanced step. Try to factor in predictors of order flow, right? I attended a webinar 2 days ago made by James Dalton on a market profile, and I asked him if he agrees with the fact that as traders we need all the professional tools we can get in order to have an edge. And he totally disagreed with you. Yeah. I'm sure he would. Have you ever, like, I have to say, when you go and you look at what James, I don't want to I hate being in the position to bash people. This isn't a bash on him, okay? Maybe it's a bash on me. When I watch his webinars, he's just speaking gibberish to me, man. Shouldn't internet providers be worth more than no? Why would that doesn't make any sense at all? Do market makers pull on the close, and why not? Market makers attempt to unload all of the inventory that they have before the close. That's why when we're going into the pit close in the 10-year treasury, you will almost always see like super large bids show up all of a sudden. It's the largest players showing to everybody how much they have and trying to come to an agreement about where they're going to settle at. Watch, if you've never watched the closing auction in the 10-year, watch it. It happens at 3 p.m. Eastern time. So it happens before the equity market closes. And it's just the pit close. Like you can keep trading the futures after that, but that's just the pit close. And you'll see it. There'd be a big big bid will show up over here, and a big offer will show up over here. And then as we get closer to the time, they'll kind of compromise, and then eventually there'll be like a big transaction, and they all get filled. And everybody, closes their accounts. It was a really funny situation. Yeah, I'm going to be surprised. Somebody told me that that Dalton kind of like had moved away from the industry, and that people begged him to come back because they liked his volume profile stuff so much, is what I was told. But man, the analysis or even just the stuff that he puts on Twitter so often just seems like gibberish to me. Or like another example was he was on Anthony Crudelli's show. I was like, oh, okay, here would be a good time to learn from Dalton himself. It's like, no, he didn't. Like, what the heck was he talking? He it was just gibberish. It was nothing. It was nothing. I feel like, man, I think, you know what? I think that the market auction theory guys, they have a good theory that was based on like observations, and I think is about the best. It's about the best explanation for what the market is doing that you could ever get from just sitting and watching it. These other things that we found, the stuff that I really think replaces that theory, you only learn from real hard quantitative research. And in many cases, research on data sets that a retail trader would not traditionally have access to, right? So I think that they've taken it a step further. But, you know, if you're going to come in and you're going to make money off of selling the course, so what are you going to do? Right? You want to come in and say something that makes them think that you always have some insight into the market that's going to help them, right? Even when you don't, which is maybe kind of a problem that we have here on the stream sometimes when keeping people's attention, right? Is I can come in on a market like today, it's moving really fast on, it's moving down hardcore. So if you're a new trader, you got to be sitting there thinking, man, Seth, the treasuries are just getting crushed. How come you're not short? I could have gone short here with the micros, or sorry, with a sim account rather. I could have gone sim short over here, but I want to trade the micros. I guess we could do it now. I guess we could do it now at 2.955. I'm surprised. Oh, okay. Well, I'm surprised that nobody's up to the bids here in the 30-year. I'm surprised nobody's up the bids there in the 30-year. It looks like the 30-year is going to touch 3% though. Anyways, so you might be bored and be like, I'm not gonna watch, right? Well, guys, we don't always want to take trades, and we don't always have something that really gives us insight into the market. That's the thing is that if we need to be able to predict future order flow, if we don't have a piece of information that is going to be really effective at predicting the future order flow, then there is no reason to trade. Your expectancy in the long run without that kind of an edge is zero. It is zero. You lose everything. That's what your long-term expectancy is. So sometimes that means you got to wait. I've read his book and I liked it, but I feel that in order to monitor the current situation of the market behavior, you would really need to be in the order flow, at least to monitor certain key points. Yeah. Well, you want to talk about it more? Let's talk about it more, okay? Speculator Seth presents the problem with market profile. The problems with market profile. So let's go to the charts and pull up a volume profile chart in the S&P 500. They're very lovely. Okay. Now, first of all, what is volume profile at theory? How does this work? Let's just kind of set the groundwork about Seth's understanding of it so that anybody can come in and say, well, this is his, understanding of it is different from some, so that you can see where I'm at. Okay. Generally speaking, the way that they look at this is there's a place where there was a lot of volume traded here on the volume profile. You can see here that there's this kind of spike in this distribution around a certain area in the volume profile. And the volume profile adherence or whatever are say that this is agreement. So then you get into auction theory. So the way that they go in auction theory is they say, okay, so here is the current agreed upon price. And then what's going to happen is that it's going to be an auction. So people are going to test one way and they're going to push as far as they can until nobody is willing to buy anymore. Okay. So this is called range extension. They're going to range extension up. And here in this instance, they were not able to establish new agreement. They want to say range extension up, and then we get to this point and we find agreement, and that's the new price, right? In this case, that didn't happen. So now the sellers get to take it, and the sellers get to take it as far as they can. In this instance, the sellers weren't able to take it as far as the buyers. And so then the buyers come up and they took it even further. And then we were able to get this new bump in the volume profile signifying agreement. Okay. That is auction theory as Seth understands it. Okay. So there's a couple of problems with this, and that you'll see them in this chart in particular. Okay. The first thing is where the volume is at, where all of the volume at. A lot of the time it's because of things that don't really matter. So a big one is the point of control on this day in particular is at the close. The only reason that that's the point of control is because that was the closing price, and there's more volume happens at the close, and more volume happens at the open, right? That's why those prices have the highest spikes of volume on the profile. So does the fact that the price closed at that location really matter? I don't believe it does, to be honest with you. In fact, I would be extra suspicious of closing prices on the S&P 500 because there are a lot of people out there that have really big incentives to try and manipulate those prices and paint the tape and stuff, right? The next problem that you get into, let's see here. How do I want to? Where do I want to go next? Okay, but there's a larger flaw in the overall thinking about auction theory. Okay, and that's this: they think that lots of volume signifies agreement in the market. I can see this is like, if I was approaching this naively, that is absolutely the first conclusion that I would make. Oh, a lot of people traded that price. That must mean that they all think that that is a special price, right? That they all agree on that price, that it's okay to buy it. But when you start to become a little bit more experienced as a trader, that kind of logic starts to not make sense at all. Why would you buy it there? If this is price agreement, why are you going to buy it there if you agree that that's a fair price? Why does this make any sense? You want to buy something when you think it's undervalued. You want to sell something when you think it's overvalued, right? You don't want to be trading in the place where everybody agrees that that's a good price, right? That just means you're going to get in a position and sit there and have a hard time making any money because it doesn't go anywhere, right? So the reality, and this has been proven empirically, is that price tends to settle where supply and demand are at their minimum. Okay, let me say that again. Price tends to settle where supply and demand are at their minimum. I need to take a drink here. Price tends to settle where supply and demand are at their minimum. How did we prove that empirically? Well, what they did was they said, what if we have a Walrasian auction? There's a lot of study about these Walrasian auction things because that's how the Taiwan stock market behaves. Okay. So in the Taiwan stock market, we say in 5 minutes, we're going to do an auction. Everybody submit your limit orders. You can only submit limit orders. And At the end of the 5 minutes, then we'll do an auction and we'll match the orders up. So there will be buyers will come in and put orders like this, right? These are all of the buy orders that get submitted. And then here are all of the sell orders that get submitted. Okay. So the further away we are from the current price or whatever, the less orders we're going to have, because, you know, you want to trade. So there's going to be less overall, you know, desire to place orders the further away that we are from the current price, because you want to get filled, right? Okay. And then here in the middle is where everybody is kind of going to place their orders. Okay. So when these fill, all of this stuff here in the middle, these are all of the filled orders, right? These guys up here, they don't get filled because there was nobody to match up against them, right? So when you come and do this again, you're going to get this, right? If all of those orders from the last auction are then resubmitted for the next auction, you're going to get something like this, okay? Now, of course, there's going to be more orders are going to be added, right? Because there will be some people that got filled. But the issue here in this case is that so many people got filled here in the center. They're already filled. They're not going to submit orders the next time around. And so there's not going to be very many bids or offers in this center area. Okay. This is where I say right there, price tends to settle where supply and demand are at their minimum. Okay. So that price, at that point, it's hard to get away from that price. Like, we're going to be there for a while, and it's not going to trade very much at a time, right? But when you sit there for like 45 minutes or 2 hours or however long it is, that in the end ends up being a lot of volume. And that often ends up being these places where we see these spikes in the volume profile. Like, if you're watching the volume profile as it develops on your DOM, you're gonna see those points, right? You're gonna see it over here. Sorry, let me pull back over to the DOM. Okay, so you're gonna see at 02 was one particular place, right? And then probably in this situation, it's probably gonna be 30.5. Okay, so what that means is there is less latent liquidity at this particular area. It becomes difficult to move away from that. We're going to need a larger impulse of market selling in order to extend the range lower. Okay. So there is kind of a base theory that is there in the auction theory that is kind of wrong, right? But when you think about it, it's like, well, okay, that you might be right about that, Seth. But like, how does that change how I trade and so forth, right? Okay, well, here's how. I can see that a price is going to do that before you're going to see it on the volume profile, right? Because I'm going to see either a big collision that kind of starts that process to happen where liquidity was taken in an area too quickly. Okay, if you're coming, you have all of these like alerts and stuff set up, and you get an alert that like 3,000 contracts, 5,000 contracts traded all at once in one spot in the 10 year. Okay, if you're a big player, you typically don't want to do that. You don't want to be the one that like gets filled on that, and you don't necessarily want to be the one that threw that order out there either, because it's gonna it's gonna disrupt the liquidity and it's gonna make price stagnate in that location, right? So often when you see those big orders, just think somebody made a mistake. Generally speaking, somebody made a mistake. They don't want to show those big orders because it messes the market up. Okay, so that's the first thing, is that if you see one of those, or you come into an area where you can just see that, okay, the latent liquidity in this area really sucks. They're not bidding and offering very much here at 29.5, right? They're not bidding and offering very much here at 29.5. And that might not necessarily be because there was already a large transaction. It could just mean that they don't like that price. Okay. And so here you come into that area where supply and demand are at their minimum and it's going to sit there. Okay. Now, range extension. What is range extension all about? Well, I think this whole idea that like, well, we're just going to test it here is kind of silly. The people that have tons of money, they don't just make these trades just like on a whim. Okay. No, the reality is that there are large players in the markets that have to execute a large number of trades, and their moves as they make those trades have an impact on the market. So we can think of those as meta orders. Okay, a meta order is a large order that you could not execute all at once. So it's all part of like the same trade. And a meta order might not necessarily be all by one guy. Maybe it's a group of traders all trading on the same premise, for instance, right? Like we could come in here, let's do it on the treasury, okay? Now we'll move over to the treasury. So we're getting the move down here today. What's that about? Well, we know. There's a large sell meta order right here that is based on the PCE report that we got, right? Large meta order sell, and it has an impact on the market. Okay. Now, there are a couple of empirical properties about the behavior of meta orders that we've been able to glean from looking at proprietary data sets. Essentially, firms gave scholarly researchers at the universities these proprietary data sets so that they could see, okay, when they were executing an order of this much, how much did it move the market? Okay. Does that make sense? If I'm executing 1% of the daily volume, what will be the change in price? That makes sense? And when they did this research, they found that the data was extremely consistent, followed a law very consistently. And that law is this: the change in price is equal to a constant, which is different for every instrument, but is very consistent over time. It may change, but from day to day, it's pretty much the same. And this tends to be between 0.5 and 1, okay? This constant, okay? Times omega, which is the symbol that market researchers use for volatility, okay? So so you could use like average true range here, for instance, right? The average true range times the square root of Q, which is the size of our meta order, over V. And it tends to follow this law, right? Well, this is a really interesting equation because of this square root thing. Because what if we said that our Q was 0.1 of V, 0.01 of V, 1% of the volume, 0.1% of the volume, right? Then these V's cancel out, right? So now we have C omega times the square root of 0.01. And you know what the square root of 0.01 is? That's like the same as the square root of 1 over the square root of 100, right? Which is actually the same as 1 over 10, right? So it ends up being the constant times omega times 0.1, right? 1% of the volume can be responsible for 10% of the volatility. Okay, so orders have a very dramatic impact on price. They're inelastic. Prices are inelastic. So if somebody comes in and starts buying something, it's actually very easy for it to get things to move. Your traders think like it takes a lot to get the market to move. It's not. You can just sneeze and you can move the market. And so relatively speaking, for these big guys, it's just like sneezing can move the market. Okay. So if a large fund is rebalancing, it could move price up. If a big trader is just bored, could move price down. Right. And we can determine based on this square root law, because what happens when you chart this square root law out? So you're going to get something like this. Here is the volume, and here is the impact that you're having, and it's going to go like this, right? There's a square root, goes on forever and kind of converges to a certain point, right? So there is like kind of a limit on how much impact you can have. Now there is a point at which this law breaks, and then the impact like just goes up exponentially. Okay. But where is that point that you're getting to right there? Why does that happen? Well, it's because of those liquidity holes that we talked about, right? Supply and demand becomes at its minimum. The market makers can't handle it anymore. So here, like you can see it in this price right now. Let me come back to the chart. We'll come back. We're having an awfully strong trend down, man. I gotta say, this is not a trend that I feel comfortable trading because of the current liquidity conditions. But my, oh my. Oh, what is the? Oh yeah, because I increased that. That's why. I'm like, why is this so big? Okay. What are we doing? CN. Okay. So if we were to assume that a market was 100% efficient, then as soon as that number comes out, we should be able to calculate what the new price is, and it should just immediately go to that price and settle there, right? That's not what happened. Why not? Because the book can't handle it. Because of the square root law. So you're going to get this. Down. Okay. And here's the liquidity hole, right? And then when the liquidity hole heals, then you get another one down. Down. Now we're getting a more extreme move down. Okay. So that's what causes these. Now, another thing that we kind of got going on here. So that's the first law, the square root law. The next one is we want our volume chart, right? Yeah. And yes. The next one is the square root law. So when you move down like this here, what that does is that harms all of the liquidity behind you, right? So if you have a large meta order that sells, and then down in here, you get a large meta order buying, that second order is going to have more impact because it's tracing back over this ground that they had already treaded. So the more aggressive that original move was, that like the faster that it happened, the easier it's going to be for them to push it back the other way, right? So if you're somebody that's, like this whole range extension thing, and you say, okay, we're going to do range extension and we're going to push it up until we find like agreement. But then if it's very easy for them to snap it back on you, to trade against you, essentially, which is why it's kind of like, if you're a big guy and you really want to like get the best price, you really kind of want to wait for a move against you and then hit into it, because you're going to, if let's say in this chart, right, what would be the difference between executing right here and executing right here? Well, like in this instance, you got these prices, but in this instance, you got these prices. And generally speaking, your average position is going to be a little bit lower, but you actually made the price move more in your favor. So not only did you get a lower price, but you've got a trade that has some momentum that hopefully other people will jump on it and keep pushing it, right? It'll come back a little bit, but it'll keep pushing it. But you got to be careful, because If somebody came in and met an order sold, it could totally come what? In this instance, of course, it didn't happen because there wouldn't be enough time in the day, right? It's a new day and all of the liquidity has changed. But this is what we call inverse sine law, right? Inverse sine law, which is kind of another consequence of these liquidity holes that we talked about. It happens because of that wall Eurasian auction thing, those liquidity holes, right? So that is like our deeper understanding of the markets now that goes beyond what volume profile teaches us, right? So the big flaw that I see in volume profile is that they say that this price right here matters. They say that this price over here matters. They think that in all likelihood, the S&P 500 is going to go back to this price because it was the most traded price. Well, that is the fallacy of technical analysis. Why? Because that price was important before, why would it be important now? Well, they think, well, that price was important before because that's where they agreed. But it's not where they agreed. That's just where supply and demand were at their minimum at the time, right? So if we have a move away from it, there's no reason to come back to it unless somebody takes the opposite trade, and then it's probably going to bust right back through it, right? So do you see how this kind of gives you a better framework to work from? Like it's not like volume profile was dead wrong. Like I said, volume profile is probably the best theory of markets that you could get from being a trader and just watching it from day to day, right? They were using real observations. But what happened was the quants came in, they had better data, they had better forms of analysis, and they were able to discover things that really, really massively expanded our understanding of how markets work, right? And so if we use that as our framework, we can make much better analysis, right? The other big advantage of understanding this stuff is that then we get into this point of, okay, well, so the thing that really moves the market are these large meta orders, right? How can I predict these large meta orders? Well, there are some things that maybe we can use to predict those large meta orders. Probably the most common and most impactful thing that we can use is changes in perceptions about future order flows and fundamentals, right? So if we think that the core PCE price data that we just got is going to make the Federal Reserve more likely to be hawkish, then I want to sell the treasuries because I know that other people are going to sell the treasuries because of that perceived change in fundamentals. That's going to trigger people to trade, and I can try and front run those orders, right? So now, when we come in the morning, instead of saying, okay, here is where we had agreement, and I think that the market will come up to here and then come back to here, and I'm not saying that that's like an awful way to trade or anything like that. I'm just saying I think we have a better way. I think that we can come in instead and we can say, what are the predictors of order flow that we have today? Okay, so what are some predictors of order flow that we have today? Well, number one is we had some economic news, right? By the way, do we have stuff later today? We do. Yeah, we have University of Michigan sentiment numbers today. So that's a big one because they do have inflation expectations in it. Okay, so we have that news. We have the news that we had an hour ago, right? The PCE inflation report, which we know can trigger a lot of orders because it's the Federal Reserve's favored inflation metric. Okay. Another big flow that we're going to have today is that it's Friday. There are people that don't like holding positions over the weekend, and so they're going to be closing their positions or whatever the deal is because it is a Friday, right? There's going to be gamma hedging, right? There's market makers that have, taken on options, and as the market moves, they're going to have to buy and sell the shares of underlying stocks to keep their positions gamma neutral. And that could move the market, right? Overall sentiment is something that matters. Okay, just right now the sentiment in the S&P 500 is a little damaged this week, wouldn't you say? Makes it a little bit harder for them to buy in the S&P 500. Another really big one, I think this is a really, really big one for the Treasury, is the end of the month. And the end of the month and the first day of the month tend to be buys, because the dealers, the people that like sell these bonds, people on the cash market to like their clients and stuff, they like buy all of their inventory at the beginning of the month. Okay, so there tends to be buying on days like this. Don't be surprised if in the Treasury that, Michigan Final does its thing, but then after they do its thing, don't be surprised if there's not some bubble up. They might not get back up to these prices again, but I wouldn't be surprised if going into the close that you're seeing a little bit of bubble up as they kind of buy some inventory. Although in this particular instance, I'm thinking maybe they want to do it on Monday. They might do more of it on Monday. Monday might be more likely to be a buy day, right? Okay. So now that we have a list of things that might predict future order flows, which includes seasonality, is basically what I was talking about there. Okay. Now we can try and make some decisions about how we want to execute, right? So if we think that overall the conditions are such that the predictors of order flow are in favor of buying, right? In the S&P 500, for instance, then I'm going to want to use my knowledge of the liquidity to try and get myself an optimal entry, right? So here in the S&P 500, if we open up and like that initial swing is like a sell and I'm looking to buy it, that might be a really great place to buy, especially if I'm seeing them push down and all of a sudden they're getting into an area where there's like some absorption and stuff. Yeah, because if there really is some large meta order buys, it's gonna slingshot it back the other way because of the inverse sine law, right? So you can kind of use the volume profile to tactically do things. You can see it over here in the Treasury as well, right? If I wanted to go short, right, when it was at 118.30, and I want to go short, it was kind of like, well, yes, we could go short, but we got this thing. So we know that this thing is kind of going to be a magnet. In this particular instance, I think that the market is still slippery enough that we were able to push out of that hole. But then look, it came right back to it. If you didn't take your profits, you'd still be right at break even, right? And what if you had been the guy that had sold at like 28, knowing that the supply and demand are at their minimum over here, right? Well, there's a really good chance if it doesn't break out right then, it's going to get sucked back up to here. So if you're going to take that one, and I'm not saying that you can't take that one if you see the momentum and stuff, but you're going to keep it on a short leash, right? And this is where it's like, it's not like the edges that we have in the order flow like are super predictive all the time and everything else like that. But it's like when we combine all of those things together, that information tells us that certain places are going to be better to execute things than others, right? It also gives us a really good framework to determine that we're wrong about something, right? If I'm in the treasuries here, and my opinion is that it's going to be a trend day down, the order flow that we're seeing right now. So let's just come back over here and look at what the cumulative delta is, right? Okay. So we had the initial sell during that news. Okay. And now it's kind of flat. Okay. So it coming back up to this area is most likely just because of the liquidity hole and everything else, right? So it coming back to that price does not necessarily concern us. But if we start to see, the cumulative delta rises and it comes back to zero, that puts a real wrench in the whole theory that we're just going to have a trend down day, right? Because there's somebody out there is executing a large meta order buy, and their large meta order buy is going to have a lot of impact because of how fast the down move was, right? You can see that and you kind of got to be careful. Like, oh, I didn't even show you this chart. You can see like the cumulative delta is not flipping back up yet, but we are breaking these highs. Okay. So I'm not necessarily looking to take it, but maybe if I am looking to buy, I think. At 7:44. Okay, so we got the data in 15 minutes. Something that we might see happen. Another thing that we can kind of game out using our predictors of order flows is that if I am somebody that wants to come in and buy the treasuries, right, I'm going to wait until all of the news is done first. So they're going to wait for the University of Michigan conditions. Something that you could see happen is the sentiment numbers come out and are in line with expectations, and nothing really happens, and then you get this bubble up move because they were always going to be buying it, right? Like these guys, they've got a block order to execute, and that was just kind of, they needed to wait till a certain time to do it, sort of a thing, right? If we want to have success in a purely competitive intellectual game, if you're not having success, that means that you're going to have to evolve. Your understanding of this subject is going to have to change and is going to have to grow deeper. Volume profile was great, guys. It really was great, and I think that it's helped a lot of people understand the market. Okay, but it's like, that was the 80s. Okay, Dalton made his name in the 80s. This is 30 years ago. There's 30 years of research out there from quantitative researchers, from absolutely brilliant people that are just way smarter than me. And their edges that completely changed the way that the large institutions execute, right? It used to be large institution would use the VWAP, and then the retail traders kind of caught on wind of that and would kind of exploit it against them. But once they learned all of this stuff about the empirical properties of the order book and executing orders and everything, what they realized was that just spreading your orders out mattered more. To reducing your impact on the book was more effective at executing than it was like using any kind of VWAP, PWAP sort of a thing. Right? So if they're using it, why don't we know about it? Well, I'm telling you, it's just because the research was complicated. We didn't know it was there. Okay. Banks, they knew it was there. Retail traders, we didn't know. Now you know. But like, here's the thing. You're at the beginning of this. Not very many people know about it, but we're teaching it. Other people are going to teach it. I guarantee you what's going to happen. What's going to happen is some other guy on YouTube is going to come. They're going to watch my videos, and then he's going to go and make his own videos. And it wouldn't surprise me if they had, more success, because they're going to come in and they're going to be irresponsible. And be like, this one thing, this is how I made $15,000 a day and all this kind of nonsense marketing and stuff. Makes me so sick when I see that stuff, because that there's like laws against this stuff. Okay. Right. But hey, eventually more and more people will know about this. It's inevitable because it's like proven market behavior, right? You're going to have to take it a step further, right? And that's why we're all here, and that's why I'm teaching you guys this stuff, is because now we're on the same page. Now you can say, oh, what kind of research can we do to do the next thing? Well, I think the kind of research that we want to do is, what are some predictors of order flow, right? What is some of the seasonality that we have? Can we get like a more reliable, more detailed map of what the seasonality tends to look like? I think that would be really beneficial. Volume profile doesn't show when they're raising the offers, etc., etc., etc. Yeah. Well, because once you understand the empirical properties of the order book, it's a lot easier to see what's happening as it happens, isn't it? Right. You can see where that liquidity hole is formed, and thus they could pivot around that, for instance. And I think that some experienced traders in volume profile are able to sort that out on their own, and they intuitively kind of understand those things. But a lot of the beginners don't and have problems with it, What's the reason for institutions to hide meta orders? Well, if you can see the meta order, then what you're going to do is you're going to front run it. You know that some of the most successful firms out there, that their whole gig is front running meta orders, right? Have you seen this? Go and read about the block trading scandal. There's a scandal where traders at Morgan Stanley were giving some of their favorite hedge funds information about block orders that were going to be executed in the future. And so they use that information to front run and run up. And when you look at the stats, when Morgan Stanley executes a meta order, the market moved further, right? Whereas JP Morgan, it was actually less. I think in JP Morgan's case, it might be because they don't really execute as much block orders. But Goldman Sachs, it was there too. Yeah. Anyways, it's kind of crazy because Morgan Stanley had like the biggest block trading business, but that might change now that that scandal happened. And that's what we're trying to do. But we don't have any kind of inside knowledge about that a meta order is going to be executed, right? We just have predictors of order flow. So we have some things that we know about the market that kind of allow us to guess when a large meta order might be executed, right? Like coming in, and I have to say that today could be a really like a great example, right? Well, this further move up here, it's still not on crazy volume, but it is pretty high. It is pretty high. Now they might be able to. I wouldn't be surprised if in this instance, we still got 10 minutes, that they come back to the news price and then move back down. That could happen too. But after that huge down bender move, to come in here and say that I actually think today is a buy day is kind of a little crazy, right? Just anybody using technical analysis right now is not thinking that. Certainly when we were down here, anybody using technical analysis was not thinking that, right? They were saying, I think it's going to be a sell all day sort of a thing. But I've been saying the whole time, well, I don't know if I made it as explicit as maybe I should have, but there's some real reasons for them to be buying today because it's the end of the month, right? Predictors of order flow. So yeah, I want to go through that because that's kind of like, I don't know, I'm kind of testing on you guys the different ways of teaching it to kind of figure out what helps people the most and what captures their attention the most. It kind of sounds to me from the ways that you guys reacted, that the way that I presented it really, really resonated. So maybe we should make it. I mean, we'd be retreading ground that I already have in other videos, but maybe I should make another video just to present that information in this particular way. Maybe it'd be a better video. So we can do the same thing for price action, right? So what is price action? Well, price action says there's support and resistance, and you want to trade where the support and resistance is, right? Well, when you've got this thing where supply and demand are at their minimum, right? I guess you could call this support and resistance, right? But the reality is that when a large meta order comes in, this doesn't really matter, right? What matters is the large meta order came in. So there's a big flaw with support and resistance. What's the big flaw with support and resistance? Markets are very inelastic. So everything that we know empirically about markets suggests that trying to trade off of support and resistance is not likely to be very reliable. Like, you're definitely going to see it in charts because there's going to be these locations where it gets stuck, for instance. There's also correlated assets and stuff, right? But those guys, they can't see the meta orders. Now you could come in and you could say, oh, hey, but there's every time there's a breakout, go with it, right? But how do you know that a breakout is actually a meta order? Because a lot of the time it's not, right? But if you're using predictors of order flow and you kind of know how they game out executing these orders, right? So we can come in here and say, okay, at this particular juncture, 5 minutes before pretty significant piece of news comes out, right? That large meta order might not be out there yet. It could turn crazy. Like, it could be Michigan numbers don't do anything, and then they buy it, and we end up busting the high. And think about all of the people that are short, man. Right? You see how it can give you an advantage? And I'm not like making this stuff up. It's not like I'm just really smart and I watched the market and I came up with this idea about how the markets worked. And then I traded it for a while and I made like, $100,000 this one time. And so now I'm the expert, and that proves that my theory that's not how I prove this stuff, right? No, researchers at our best universities used proprietary data sets from people like Goldman Sachs, for instance, and used quantitative data science to prove that these behaviors were a thing. It's the most you've ever made. I've made $1,000 off of a single trade before. I think probably the best one that we ever had was that trade on DWAC, Donald Trump's the SPAC that they're using to take Donald Trump's social media website public, right? We traded that on the first day that it happened. I held it overnight, so I probably could have gotten more off. That was probably the biggest trade that I've ever done. I also did a really good one on oil. At the beginning of the year, I was long calls in USO. That was really good. Jeez. On treasuries, I think the largest winner I ever had was 40 ticks, I think. But I wouldn't really read too much into any of that. I mean, if the purpose of that question was, oh, it might be interesting to hear Seth talk about his best trades, then like, let's go for it, right? But if the question is, well, how good is he really? Has he really caught a really big winner? This doesn't really matter. The winners that I've had that were big winners are like kind of like, yeah, it just with the randomness of the market, you're probably going to catch one of those. You know what I mean? Have you made money this year? So not when you factor in the data fees. Not when you factor in the data fees. But I'm doing okay. I'm really happy with how I'm doing. What I'm doing is and we've been doing it now for, well, I mean, it's been 4 months this year, and we started doing it when the micros went live, right? So I'm not going to say like this is like some huge profitable venture, but it does appear to be sustainable, and we've been getting better. I think that I just kind of went through a bit of a drawdown, and I seem to be recovering okay. Well, we had a drawdown in March, and in April we made that back. Man, in March I was like, I just want to give up. But I think that my understanding of that market wasn't very good. That's kind of the big problem. So the focus here from here on out, for me at least, the things that are probably going to help me out the most is some psychology things. So making sure that I am performing my best, because when I get a bad trade, it really does affect me, doesn't it? Because I'm ADHD. If I don't get that chemical boost, then my decision making isn't as good, right? But then the other thing is understanding the market. So I think that this month I've had a much better understanding of when I understand the market and when I should and should not trade. Martin Wordgell works until it doesn't and you blow up. Yeah. Well, the thing is that a lot of the things that people out there are teaching are basically the same thing as martingales, right? Like all of these, what do we call? I'm going to call it risk management. They don't actually provide you edge. What they do is they change the statistical properties of your returns, but they're not actually going to make you make money. It's just often what it does is it increases the kurtosis of your returns, which means that and now instead of it being, you win one and you lose one and your strategy looks like your profit and loss looks like this, they change it so that your profit and loss looks like this. Right? And so then and this is blowing your account, right? and so what happens is it takes longer for you to realize that the strategy doesn't work. And this is a really guys, this is like one of my biggest pet peeves. I don't know how to like get it across to traders because I see so many traders fall for this. Okay. The more successful an online guru is, the more likely they are doing this. They almost always, okay, so here's the news. Okay. So 65 spot 2 versus 65 spot 7. And 1 year inflation 5 spot 4 versus an expectation of 5 spot 5. So this is the scenario that I was talking about, where the news doesn't appear to be doing anything, right? Okay. Anyways, back to this. It is very likely when you're looking at really successful trading educators that the strategies that they're doing basically make it so that you don't see the long run expectancy of the strategy until it's been like a year is usually what they do. And you could martingale. I'll be honest, I martingale a little bit on the stream for fun. Like you'll see me with e-minis. Sometimes I'll take like a little test trade and then I'll turn around and I'll put twice as much on, right? Even with my live account, sometimes I'll take one loser and then to feel the market out, and then the next one I'll put on 2. But I won't keep sizing up. I'll only do that once, right? The other thing that people will do is they'll say, I'm trading the S&P 500 and I'm only looking to make 4 ticks and I'm going to risk like 10 points to do it. I see that one a lot. All of the price action guys, man, why is it, if price action is so effective at predicting what the S&P 500 is doing, why do you have to have a stop that's twice as far away from your target, right? Because from my perspective, if the thing that you're trading really has like an edge to it, then your MFE should be higher and your MAE should be lower. The ticks in your favor should be way higher than the ticks against you. And I over and over again see these price action traders where the ticks against them are higher than the ticks in their favor, but they're still making money because they have a larger stop. Right? I see that all the time. The other one is averaging out on contracts, right? So what you'll do is a similar sort of thing, but you do with multiple contracts so that people don't realize that that's what's happening, right? You say, okay, I'm going to buy 3 and I'll have my stop be like 8 ticks away, but then my first target will be 4 ticks away, and then my next target will be here, and then at one point I'll move the rest that I have up to break even. So these are all risk management strategies, right? But again, what will happen is if you get into a market where every time that you get into it, it immediately goes down and hits your full stop, the amount that you lose on a full stop is way more than what you make on average when you're averaging out. And so, but generally speaking, it's going to work. It's going to look good. Yeah. High probability entries don't make for good stream viewership. Well, no, I think that the problem is really worse than that, which is that we as retail traders, there's not that many high probability setups for us available. And to be honest with you, like it's just what we're doing is just really, really freaking hard. Now that doesn't work for good stream viewership, right? What they want to hear you say is, yes, I make money every day. $1,000 every day, and you can do it too. That's what they say. Hey, if you just seriously, if you go to a trading education website and they have any kind of number on their website, like about how much money you're going to make, walk away. Okay? Because that is essentially against FTC rules. The FTC rules, like you can't be going around giving people promises of big gains. Like you give them unrealistic ideas about how much money they're going to make. That's why warrior trade. That's why warrior trading got caught, right? That's what they cracked down on him for. It just, the people that know what they're doing. Okay, like I'll tell you, here's some people that I think are respectful in the industry. Okay, Anthony Crudelli, Futures Trader 71. I've never, ever, 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 ever seen them say, I make X $1,000 a day and you can too. They don't mention numbers. They don't ever even talk about their performance. Okay. If you really know, if you're there could be lots of reasons you want to be a trading educator. Okay. Let's just be honest here. Trading sucks, man. The only reason I do it is because I love it. The only reason I do it is because I absolutely love it. Because otherwise, I could put my effort into so many different things that I would probably make more money, right? But this is the thing that continues to hold my interest is trading. I love it, right? But there could be lots of reasons to be a trading educator, okay? But if you're like in the industry and you're experienced and you really know what you're doing, then you're going to know what the rules are, and will never mention numbers. You'll just never mention numbers. Seriously. Well, it's not, I've been watching this kind of like hoping that they might give me a good price. I think for Sim here, I'm just, kind of as an example trading, because if we do break highs, I want to be able to say, like, look, see, this is how we could have done it. But I would much rather be picking it up somewhere down here, right? Imagine waiting 4 days on stream to the long 41.50. Yeah. And then that leads to a generation of new traders with bad habits from the get-go. Yeah. Well, here's what I don't understand is why do so many traders find price action so attractive? It's, it wasn't always like this, but somewhere in like 2019, I would say, it was just like all of a sudden you got these people on Reddit that were just like really huge advocates of price action. It's just all of a sudden there's all these guys, yep, just support and resistance price action. That's all you need, guys, and you'll make money. They're like really like they post about it overly enthusiastic. I almost have to wonder if it's not like people being paid to push price action so that these price action educators get more customers. I don't know. But a lot of the price action that I'm seeing taught out there, yeah, gives traders bad habits. Look, I have bad habits too. But that's why I always come back to this whole thing that's like, when I'm teaching you guys stuff, I'm not basing it on, I'm not a guru. A guru is somebody that their authority is based on their past success. Okay. Don't follow gurus. follow experts. Okay. Experts are people whose authority is derived from the data. They know more about the data, right? And especially when it comes to the stock market, follow experts, not gurus. Okay? Because past performance is not indicative of future results. And you see this over and over and over and over and over again. Is that anytime that somebody comes to prominence as the guru, okay? Jim Cramer, great example. Okay. Listen, you come on TV every day and you make proclamations about practically every stock out there, right? You're going to make some mistakes. That's the problem with Jim. He has a lot of good information to share, but it's a guru. I think probably the even better, more recent example is Cathie Wood. Cathie Wood came to prominence, became a guru because of her success in the 2020 market. And then what happened? She got decimated. Oh my gosh, that fund just got annihilated. You know what? Like the whole thing is that her success was really all based on her having her own impact. Because she had made so much on Tesla, then all of these other people came in and started investing into the fund. And then the fund started investing into all of those companies, and those companies rose because they were putting more money into the market. But eventually people redeemed it, and it all deflated back down because it wasn't based on like the fundamentals of those companies or anything. It was all just they were being fooled by their own market impact, right? So what's the point of that? You can be successful and have like be dead wrong about how to do things. Right? Like there are people that just get lucky or like they haven't seen the problems with what they're doing yet. And it happens all the time. All the time. So don't follow guru, follow experts. Look for people that understand the data and can prove things to you with the data, right? If somebody comes up and they say, here's this great setup, when X thing happens and then you go long, first question you should be asking yourself, what are the stats on that strategy? What's the win rate over the last 5 years? What is your average favorable ticks versus adverse ticks, right? What is the Sharpe ratio of the daily returns using that strategy, right? Is because what happens is when you really get into the data, number one, they probably don't have data. It's just always, they never have data. They never have. Why don't they have data, guys? If it works, you would think you would test it and prove it. I guess usually these people don't have the skills to do that. Unfortunately, I really think that everybody can learn to do Ninja Trader programming and test basic price setups, right? But most people just don't bother. But then problem number two is that they don't show you those stats, because if you did show those stats, you would realize that they're not that good. Right? It's like, yes, you were making $2,000 a day, but you were having drawdowns of like $50,000. You know? Yeah. And yeah, we got a whole generation of new traders that have bad habits from the get-go. Listen, guys, I want traders to be better. I want the retail crowd to be better at trading. I think that there was a time when there was the locals in the 80s and 90s. There was these guys that came from nothing, and they had edge, and they controlled those markets. Bravo. That's awesome. It's not the case anymore, man. Now we're like nothing. Retail traders were nothing. The retail traders just perform so poorly. Like the majority of retail traders are going to fail no matter what. Let's just take out all of the people that don't trade for very long. You take people that try to trade for 3 to 5 years, okay? The majority of those people are not going to make money, okay? But it's like 95% lose money. It should be more like 60, 70% lose money. right? We can bring that margin in a little bit. And how are we going to do that? Well, we got this information. We're going to teach people to follow the data, follow experts, not gurus. And you guys are the strongest weapon in all of this, because I only have so much reach. The YouTube algorithm only sends so many people to me, right? But what's going to happen is you guys are the next set of mentors, right? I mean, I'm mentoring you. Someday you're going to be turning around and you're going to be mentoring other people. And when you mentor those people, you're going to teach them what I taught you, which is you follow experts, not gurus, right? The reason that I'm an effective mentor for you is because I understand the data and I can prove these things to you and I know where to look. It's not because I made a ton of money in the past, right? Maybe I did make a ton of money in the past, but that's not what I'm deriving my authority on. My authority is on the evidence, so that you're always looking at what is the evidence. If I have a theory about how the market works, what I should be doing, try to generate some evidence to support that theory, right? It's so much better of a way. And if we can get, it'll be slow. It'll take many generations of traders, but maybe we can change that. And you guys are our biggest weapon in that, right? You are now that I've shared with you some really valuable information, right? You're obligated to turn around and share with other people, okay? Because we need the world to know this stuff, okay? Like, yeah, we want to have edge, and other traders not knowing this stuff does kind of give us an advantage and help us make money, okay? But having more retail traders out there that actually understand what's going on also helps us, okay? Because now we can collaborate and we can start to develop more edges to fight back against the HFTs and the institutions and stuff, right? Oh, did I not? Well, okay. I'll take that one. So probably a little bit too late. Oh, no. We're okay. We're okay. Actually, yeah, I will. Okay, I'll do that. I'll manage it like that. People follow their desire, not what's right. Well, but that's where I think that we can still kind of use that and then guide them onto the right path, right? I think that they're coming in and explaining to people like, look, you've been trading for a while, because most of these people, they've been trading for a while. You've been trading for a while. You're not really having a whole lot of success, right? Do you think that if you just continue doing what you're doing, eventually you're just going to think right and then you can start making money? It doesn't work that way, man. You need to evolve. You need to change what you're doing. You need to evolve. You need to expand your understanding of the markets. And what people have been teaching you out there isn't all there is. There's this whole other world that they aren't talking about on Reddit, that they aren't talking about on the forums, except for me. Except I'm like literally the only person out on social media talking about this stuff at the time. It's going to grow. It's going to grow. But guys, there's this whole other world. And there's this whole other world that I don't know about. Machine learning, and man, I'm getting into it, but there's all this stuff about machine learning that I don't know, and that's the next frontier. And then after machine learning, there's going to be quantum computers, and people are going to use quantum computers to make better trading decisions. And it's just going to go on and on and on. You gotta keep up with the times. You got to continually evolve if you want to continue to have success in trading. So why is it that people are continuing to rely almost solely on methods that were basically thought up of 30 years ago? Like, seriously, market profile is older than me. Older than me. Well, it's been about 20 minutes. We did get, there was that really strong move up. It kind of looks like they might come back down into the bottom end of that range again. But I am starting to think that we're getting into the time where we might want to laser in a little bit. Focus in on the order flow a little bit more. Not only that, but I think I said my piece. Probably took it a little bit too far, huh? Like, Seth, you're not all that. Yeah, I get it. I'm not. Trading's hard, guys. Trading's hard. Don't do it. Go make a YouTube channel. You know what? A YouTube channel is hard too. I have to take some of my own advice too. I've done a lot of work on getting really good quality in my videos, in improving kind of like the I don't know how to put it. Like working on storytelling and engagement and catching people's attention at the beginning and things like that. And we have been doing better, but our channel needs to evolve too. We worked on TikTok. We've been working on like focusing more on current market happenings, but that hasn't yielded as much as I had hoped. So channel needs to continue to evolve. So I'm still out there. And how do I do that? I'm looking for data, right? I'm looking for. I don't just want, hey, I have a really big YouTube channel. You should listen to me. No, I want to know, like, can you prove how the algorithm works currently and that this particular thing gives you benefit? What was the news? Well, I was talking about the consumer sentiment. So we had this really strong aggressive move all the way back up before the consumer sentiment number. And now we've kind of fallen into this hole around 08. We're at the bottom end of that hole right now. We are seeing, yeah, it's a good point, Tobias, is that we are seeing some movement in the S&P 500 kind of breaking some downside points. Okay. So was it negative? No, it was mostly in line. The numbers were mostly in line. So that's where we think, and it, so far, the flow that we're seeing right here is not in line with our theory. So I've got this sim trade on here where I was trying to take advantage of the range. We may have to puke this sim trade, but I'm watching over here in the micros, and I'm seeing that our opportunity might be coming. But that move down is not in line with our overall theory. So I think for the time being, we kind of have to hold back still. But yeah, I'm a little bit concerned about the equities here, to be honest with you. The yesterday was not very good. Like Amazon earnings were bad, Apple earnings were bad, the GDP number, like everything was bad, but the S&P 500 rallied. Like what? And I think that a lot of that was just short covering. So I'm a little concerned that like we're not out of the woods yet, because from a technical perspective, I think a lot of people would be saying like yesterday was like, hey, that's the day that we're gonna buy, that's the bottom, we're all in, that sort of thing, you know. No, Apple was generally okay. Like the top line numbers were good, but then when they started getting into guidance, they were suggesting that like I think it was like an $8 billion expected loss in the future because of supply constraints. So the earnings were good, but the guidance wasn't from Apple. Yeah. And I believe that they did fall in aftermarket. I don't know where they're at right now. We could go and check that out. I could please that. I want to feel. I was really hoping that they were going to give me 92, but Nope. The spread the spread was okay up here actually. So, but the spread right now is kind of making it so that like I'm not sure if I'm going to be able to take the trade that I want, because I'm not going to take the trade if I'm not getting an advantageous price. So that's kind of the market making side of it, right? Like if I'm gonna take a limit order, like they give me a good price, because otherwise I'm crossing the divide to 2.905 at the bottom of the range. This is not very. You're paying too many ticks to take that trade, I think. Okay, so they did fill me. I'm happy about that. If they came all the way up to 11, then I'm gonna look golden, right? But what am I doing? I'm averaging into some. I averaged into something, and now I'm averaging out. So that's really does not necessarily prove that what I'm doing has edge per se, because I'm manipulating the risk parameters of it, right? But here's the thing: if you do have edge, and then you come in and you manipulate the risk parameters of it, that's where you can start to make tons of money from doing it, right? So it's not like doing those sorts of things are bad. It's just that like you really have to be sure that the underlying thing really has edge first. Is there a VIX for treasuries? There is, but most of us in futures aren't going to have access to the data. So you're going to have to go on to like Trading View and get it delayed. I forget what the symbol was. So you can go, we can go and we can find it for us though. If we come into Trading View, I have a video that is about volatility projected range, I believe it is. Where I kind of talk about what this is doing. But essentially, I'm going to use that volatility index to make a prediction about how far it's going to go today. So first let's pull up ZN futures, 10-year note futures. And then I think it is, let's see here, it's move or something like that. Index. No, what is it? Treasury volatility. Oh yeah, that's right. No, you got it right. I think you're right. TYVIX. Yeah. TYVX. Yes. Okay. New pane. I'll put it down there just so you can kind of see it. Oh, it's not. Can I only see it on a daily chart? Yeah. Oh, but it doesn't go back all the way. No, that's not it. Treasury volatility. Then there was another one like move index. That's weird that it stops giving us data in mid 2020. The last time I looked at this was in 2020, so I guess we can't. I guess the answer is no. Also, they're giving me an opportunity to put another contract on. I could potentially, like if we made this range again. I'm a little concerned about it dropping a bit more though. Yeah, I thought it was move. But that wasn't pulling anything up. Well, let's come back in here. Move. Maybe all. Oh, there we go. ICE Bulfamil bond market option volatility estimate. Yeah, we can use move. Yeah, oh, it's even going to give us intraday data. Okay, cool. So now we can do ZN futures. And then indicators. And then we got this VIX range estimate indicator. Did it add it? Oh, I think I added it twice. Yeah, I did. Okay. Okay, and then I can come into the settings in here and I can change the index to be, oh wait, what was it? TVC move. TVC move. Okay. TVC move. Okay. Does that work? Let's do 30-minute bars. I don't know if that actually did it. Wait, if I just get rid of this. No, that didn't do it. I don't know if it's actually picking it up, to be honest with you. What are these? Yeah. I've gotten it to work before, but I don't know what I gotta do. For intraday, it's better to use VX futures because the VIX showing risk for the, yeah. I mean, it works really, really well for the ES, right? Maybe the TVC is, maybe that is right, actually, because it definitely doesn't match. It's just that the factor that we need to use on it is probably like way different. Anyways, if I switch it to ES and remove that old one and add it on again clean, then you get these things where it's like, oh yeah, look at that. It turns almost on a dime at those spots. The execute trades, no, my data is coming through Ninja and then coming to Jigsaw Day Trader through the bridge. But I am using Jigsaw for I place all of my trades on the DOM. And this one that I'm doing here in the treasury is a sim trade. I'm too terrified to do it on my live account here at this moment. I'm too scared. I just really hate the spread that they're given. You know. Plus it's probably been, well, I don't know. I think I'm going to give it another 15 minutes. But you know, we're kind of getting into it's too late to do something. I usually stop at the top of the hour, and it doesn't look like the trade is turning out the way that we wanted it to. This was okay. I wish that I had been able to get another contract taken off here so that I could add more aggressively here, but for fun's sake, it's all for fun. And that one. Man, I know I've been able, I've pulled it up before, but maybe I was using a different factor. I don't know. I haven't looked at that one so much because I find it's really, really indicative of where the S&P 500 it goes, but it's just so freaking hard to trade the treasuries. Well, we've had the down move here today. They kind of look like they might be headed for 4,200 again, huh? But I think that if I'm trading the ES, I think I kind of got to be on the lookout for like a flush lower and then it buy the rest of the day again. You know? Okay, well there was a tick up in the treasury. But I'm not detecting a change in the volume. Like if a meta order is going to be coming in long here, it's not happening yet. It's not happening yet. We're not really seeing hardly any trade come through. I think with the thing, kind of the move that we're looking for, it might be more Monday, right? It might happen more Monday. Oh yeah, so I left that message in Jigsaw. Did anybody like respond or say anything? Oh jeez. Oh, Celine caught a big one. Good job. I mean, I guess I could have gotten 5 and it wouldn't have been bad. I'm definitely seeing like the bid absorbing. Well, that might be the best I get. Oh, whoops. That's not what I wanted. That order that was sitting there. Well, I didn't get the opportunity to take him, but I was like that. I might be able to take advantage of that, but I didn't have my account armed. They fell back to 05 again, huh? Well, since it seems like they're kind of so quiet here in this area, I'm gonna try and quietly play this range a little bit. Uh-oh. I wonder if I'm having data problems here. Because my all of my treasuries just kind of froze. Will Biden forgiving student loans help the market? It's not gonna happen. This is a carrot that they hold out for the youth because the youth aren't very hot on the Democrat Party right now, and that's the thing that they think they can use to get them engaged again. But it's not the American public like overwhelmingly is overwhelmingly against forgiving student loans completely. Because honestly, most people don't go to university, right? Most people don't go to school, and so you're talking about charging the majority of people for something that a minority of the most privileged people, a problem that the most privileged people have, right? Like it's like bad politics. Like I dare Democrats to do it because it would be such a disaster for their party. It would be like, it would be so polarizing that now the only people that would be in your favor would be those people that got their student loans forgiven, right? But you'd have a very hard time getting anybody else on board. And they would then become just a complete slave to that one demographic. It would be really bad. I really don't think it's going to happen. I really don't think it's going to happen, and I'm just kind of surprised that it's even being discussed seriously. I don't know. Okay, well, everything seems to be going now, but I think that my data was kind of messed up there for a little bit. Oh man, yeah, S&P 500 just looks so sad. It's so sad. If I don't go to school, will he forgive my car loan instead? It really is like some of these people, some of the stories that I hear on Reddit when people arguing against this, I'm really like, man, this is such a terrible, terrible idea, guys. Oh, I could see I could hit this guy at 2919, or I think it's a robot, but I'm not going to. I'm gonna hold off on it a second more, a little bit more longer. Okay, well that looks nice. I'll take that sign right there. How do you confirm absorption on the DOM? Because if the meta orders are hidden in the time frames and sales telling you selling pressure, then you'll just see the price is not able to move lower. Okay, well, so the way that they hide meta orders is they execute them over time, right? So when I come over here and I look at like my cumulative delta, you know, if there was a large meta order executing over the last 30 minutes, we would see it. Like we would see that overall that there's more market buying and price kind of gently moving up, right? But we're not seeing that right now, right? Really the kind of the problem that I always found was that by the time you're sure that something is happening, the liquidity hole forms. Like the reason the liquidity hole forms is because everybody's gotten to the point that like, okay, yeah, something's definitely going on. There's a meta order going this way, right? So you really kind of have to have an inkling that it's going to happen before it happens, and preferably when price is going the other way, right? But where it becomes more beneficial is then definitely like verifying, right? Like if I had been short if I had I actually chosen to take out that guy at 2.19, right? And all of this and all of a sudden I started to see this. Okay, so we are getting it though. Jeez. Well, they're not helping the way that this kind of played out. They're like, okay, Seth, if we're not you, we gave you this one opportunity here. If you're not going to take it, then we're just going to go without you. We're just going to go without you. You know, like right now, that last up move is kind of a little bit too much of a tell, don't you think? But I think that some retail traders would still be a little bit like, oh, well, they're just coming back to the other end of the range, right? But you can see it in the volume, the way that they traded it. And that's weird. The spread has come in here. I think I still need to be a little bit picky here because I kind of get some, I'm kind of getting some sense that they're painting the tape here. So they had like that 8 tick up move, and now they're petering out really quickly again, right? This may be intended to try and give the technical analyst guys more confidence in a short to try and get more volume to come through here. It's not really coming though. The volume's not like, look there's 05 again. Is anybody hitting it? No. And the ticks down wasn't very much volume either. Nope. And these aren't going back either. That must be because of the spreads, huh? No, well, the 30 is coming down. Kind of looks like they've been trying to steepen back out after that news caused all sorts of havoc. Oh, so okay, so we did get filled there. Good deal. Oh wait, what would it be? What? My initial entry on this wasn't very good, right? Why is it still selling? Well, so let's just note that wasn't very much volume on the way down, right? Now there we might be getting more here now that they've passed 05, but down to here it wasn't a lot of volume, right? When I come in and look at correlations, I don't really see the 6J moving all that much. I do see the S&P 500 looks really ugly, but with the S&P 500 looking so ugly, you would think that they would be buying up the treasuries, right? So that can't be it. So I don't that's why I'm kind of suspicious about it. You get what I mean? Like, because I'm on the lookout for a meta order buy, and we kind of got a little bit of a hint of one, and then it got smacked down. But there doesn't seem to be a very good reason for it. So in this situation, either we're dead wrong and actually the call is short, or they're playing with us here. Now I'm wondering if there's some really shady things about the liquidity here in the micros as well. Okay, somebody really wants to get filled that 925, huh? All right. Okay, well they filled them. See what's with this spread. Oh, I need to come in and maybe I need to come in and make one of those charts for the 10-year to see what the spread really should be. There seems to be a really wide discrepancy here. Okay. I'm also wondering why the bids seem to be more reliable than the offers here. I heard the news quack saying something about Donbass there. I don't know if that was significant. Russia appears to be behind schedule on military operations in Donbass, says U.S. official. Ah, I see. Okay, so now they're getting some fight at 05.5, right? $1,300 I'm thinking that the S&P 500 is going to go past that 4,200 again. They've been toying with it a lot this week. Wow, Musk has lined up a new chief executive for Twitter. One of the sources added, declining to name the identity of that person. Well, it's 8:47. I think we'll leave this sim trade, but I'm not liking... Well, that's kind of curious. Can you see how the volume is picking up here now? Are you going to take him? That might be an opportunity to catch the edge there in the 10-year, right? 5 bid. It looks like the buys are coming in pretty good. Okay. Yep, somebody did take him, in fact. So I liked that entry. I also liked how I was able to pull out some of the range there. We are coming to the top end of this thing, though. It could, you know, there's going to be a lot of people with trend lines drawn right here above 07. Okay. Elon Musk told banks that agreed to help his $44 billion acquisition of Twitter that he could crack down on executive and board pay at the social media company in a push to slash costs and would develop new ways to monetize tweets. Three people familiar with the matter said. Musk made the pitch to the lenders as he tried to secure debt for the buyout days after submitting his offer to Twitter on April 14th, the sources said. His submission of bank commitments on April 21st were key to Twitter board accepting his best and final offer. It's looking pretty good. I'm not getting as much buying in the 30 years I would like for this, but Musk had to convince the banks that Twitter produced enough cash flow to service the debt he sought. In the end, he cinched a $13 billion in loans secured against Twitter and $12 billion in loans tied to his Tesla stock. He agreed to pay for the remainder of the consideration with his own cash. Musk's pitch to the banks constituted his vision rather than firm commitments, the sources said, and the exact cost cuts he will pursue once he owns Twitter remains unclear. The plan he outlined to banks was thin on detail, the sources added. Dude, this is looking so good so far. Look at so now that I've averaged in my position, like I only have one contract on, but that gives me enough room that, you know, I could just keep this on all day, right? Like be pretty hard. If they came to 025, I can just scratch it like fine. I'm definitely wrong at that point, right? But so far things seem to be running in our favor. Now, I'm not seeing as much cumulative delta change on this move up as I would like to see. I would like to see a good 10,000 more contracts come in, maybe. But we'll see what they do. Oh, Tobias is saying, yeah, I think so too. Yeah, on the S&P falling there. And I think the S&P falling probably helps us a little bit too, right? That they're getting awfully close and it just looks really ugly. Musk also told the banks he plans to develop new features to grow business revenue, including new ways to make money out of tweets that contain important information or go viral, the sources said. The ideas he brought up included charging a fee when a third-party website wants to quote or embed a tweet from verified individuals or organizations. Oh, that would be interesting. So if I want to link my own website, I'd have to pay. I don't know if that would go over very well, though. In a tweet earlier this month, he subsequently deleted, raft changes, blah, 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 blah. Musk has also lined up a new chief executive. Musk has been inundated with offers from potential equity partners to join him in the deal, and he will decide in the coming weeks if he teams up with someone. One of the sources said it is unlikely that Musk would partner with a private equity firm given that the deal is not structured as a traditional leveraged buyout. He will seek moderation policies on the social media platform that are as free as possible within the legal constraints of each jurisdiction Twitter operates, the sources said. Twitter would not respond. Well, so that's some interesting information, though. Okay. The micros aren't changing much, even though we're getting a lot of shuffling around here in the 10-year. Wow, really? Seems like they want out. Totally understand his what do we say? This guy looked a little scared. Now it might just be a robot. I might be reading into that, more than is actually there. Okay. 5 years still pushing, huh? Oh yeah, look at that. Yeah, 5 years wants to drag us up to new highs. Pretty easy. Oh, the 6J is moving here, man. The 6J is moving. Okay. I just heard my puppy squeak. Probably got picked up by the baby there. Okay, so there's somebody relatively large there with a bunch of orders at 91 that's holding the micro back. And maybe, I don't know. I mean, it felt like these other ones were really pushing through, but they've kind of already fallen back. So, oh, I guess they haven't fallen back. It was just 10 was as high as they got. Okay. The 5 years still looks like there's some buying pressure coming through. We're getting some steepening here, which doesn't necessarily help. He's still there. Can we see 4,300 today? Anything is possible, but doesn't look too good at the moment, does it? For the E-mini. They still haven't touched 4,200. Do you think that there's going to be another leg down? For now, the S&P 500 is kind of chilling out a little bit. Wow, Astro World movie set for release despite lawyers that's going to be a weird one. Astro World was that that incident where some people got crushed, right? Concert where some people got crushed. So it seems like that the pressure is up, but the treasuries seem to be overall having difficulty just getting activity to come in. Like the 5-year broke some highs there. Normally that would be a little bit more cause for celebration and stops and stuff. What info? We already shared all of that, NASDAQ killer. Well, I gotta get going, so I don't know. I think I'm just gonna stop the stream. I'm gonna have to figure out how I exit this, but I might just not be able to take very much out of it. But that's okay. I was a really great example of executing on a trade. So hey, I'll see you guys next week, Monday. In the meantime, have a good weekend. Stay profitable.